Hello, everybody. This is Cameron Snow again, and we're continuing with our series on geological risking for exploration drilling. In this video, which is going to be very brief, I'm going to talk about risking and capital allocation and how those two work together. So, when you are a company, even large companies, you don't have unlimited exploration dollars. So what this means is you have to choose which prospects that you want to drill. Um, Now, for many small companies, this may be obvious. You may have one good prospect or one that really stands out above all the rest. But as your company becomes larger, this selection process becomes more and more challenging. Not only are there the business decisions on why you want to potentially invest in one allocation, one exploration prospect versus another. But there's also the technical reasons. Now, we're going to focus more on the technical. Those financial reasons could be anything from better terms on a concession to concession expiration to better regional pricing. There's a number of reasons that you could choose to allocate capital on the business side. We're going to focus on the technical side, and so that often means choosing the prospect that will have the you know the best technical merits relative to the volumetrics that have been determined for it. Okay, so that's one of the reasons why risking and capital allocation go hand in hand. As we have mentioned in previous videos, the decision makers who are choosing which wells to drill, they need to be able to make strategic choices. Um, and much like there are strategic choices on the business side, there are strategic choices on the technical side as well, and those feed into the business side. So let's cover some examples of strategic choices. Um, there could be the strategic choice between drilling smaller, lower risk wells, let's say, so maybe exploration step out wells, versus, drilling higher risk, higher reward wells. So those could, that could be a strategic trade-off that you want to make. Is it better for your company to make a almost certain 10 million barrel discovery versus taking the chance to, make a 100 million or 500 million barrel discovery? That is a strategic choice. There's also choices around maybe which wells you want to drill in order to get a better understanding of your portfolio in total. So, for example, let's say you have, multiple concessions spread across multiple basins and countries. And let's say that one of your frontier areas, you've acquired the seismic data, and it looks really promising. You see a lot of good structures. Uh, you you want to go drill in this basin, but you don't understand one piece of the hydrocarbon system. Maybe you don't understand the depositional nature of the sands. Maybe you don't understand the source rock and its maturity. And so that presents a risk to every single prospect in that part of your portfolio. So let's assume for this example that it's a source rock. You've got this concession, you've got a bunch of prospects mapped up, but you don't know anything about the source rock. If you go in and you drill that well and you prove that the source rock is there and it is mature, you have removed a common risk component across all of those prospects. You may have gone from a 50% chance of success on just source rock to a near certainty, so nearly 100% chance of success on source rock. And that in itself will have, by default, doubled the chance of success for all the other prospects in that area. So, the decision makers may want to say, all right, let's drill this well knowing that it's very high risk because we don't know anything about the source rock, to de-risk the rest of the prospects. And that may be a very strategic choice because, maybe you're investing a lot of time and effort and money in the form of interpreters and setting up business operations in that area. And now you want to, you know, be able to either decide, all right, do we continue to make those investments or do we stop? And so that's where, making a strategic choice based on the technical data comes into play. One of the things that I've mentioned several times is, you know, without good risking practices, you can't balance your risk and reward. So there's a couple of things that I want to break down here. So first, there doesn't always have to be a balance between risk and reward. Sometimes you'll have very high risk, low reward opportunities, and you'll write those off almost immediately. Sometimes you'll have very high reward, very low risk opportunities. These will be things that you will pursue immediately. So an example of the latter would be Exxon's portfolio in Guyana. This is proven to be a prolific basin, um, and obviously there are many, many high reward targets, billion barrel targets that are relatively low risk now because of their understanding of that system. So they understand the depositional environment, they understand the sill, they understand the source rock. They are able to essentially shoot fish in a barrel, so to say. They've done some incredible work there, so now they have, low risk, high reward opportunities. Um, and but in many cases, you have uh, a scenario that plays out where you have low risk, low reward, and high risk, high reward. And that's because you write off the low risk, low reward. You immediately drill up your uh, low risk, high reward, and so you're left with this balance between drilling smaller, more likely to succeed wells and bigger, more likely to fail wells. And decision makers need to be able to balance that out to make sure that they are properly allocating capital. They need to understand, okay, it's 50 million barrels with a 50% chance of success versus 500 million barrels with a 5% chance of success. So they need to understand that balance so they can make an informed decision. And the best way to kind of visualize this is with a very simple example. Um, so I've got my exploration portfolio here. I'm showing the risked volumes in blue, my unrisked volumes in red. I've got some bars for the P10 and the P90 on there to kind of show the extents. Um, and so what I want to do is I wanted to think about, what can the outcomes be on a well. And so I'm going to choose one simple example here, and I'm going to play this out in a very dumbed down way, but I think it highlights the way decision makers think fairly clearly. So what you would do is you would say, okay, let's think about this prospect here that we've highlighted. Okay, so this well is going to cost us $30 million to drill, let's say. It has a 50% chance of success, so we have a 50% of a dry hole, so that's going to give us a outcome of minus 30 million. And we have a 50% chance of success uh, of the well encountering hydrocarbons, and we think in our P10, P50, P90 scenarios that we have 50, 150, 500 million of potential value. And, that's really a distribution, that goes from, maybe uneconomic below our P10 here to wildly economic as we, reach some of the higher likelihood of or higher volume cases. So, this is a simple way that decision makers can kind of visualize this and how they can think about it. So, 50 million chance that I'm sinking in 30 million, but a 50 million chance of me exceeding that, and in some cases being wildly economic. Um, and that is why understanding risk is so important, is because it gives you insight into, what is my downside, but also what is the distribution of my upside reward here. Because if all these numbers were, you know, 30, 40, 50 million instead of 50, 150, and 500, you might say, well, that's not worth, us pursuing given the risk. So, that is a very simplified example of how you can go about, taking your risking and using it to help you allocate capital. All right, I hope this video was useful to you. And in our next video, we're going to take a little bit of a tangent before we dive into the fundamentals of risking, and we're going to explore why it's critical that you have a database of your exploration prospects.